Drug addicts.
Hey gang, thank you for joining us again for another Financial Friday with Granger Financial and Jeff Granger, your host of the little 20-minute talk. I want to talk to you guys about some of the things that we've been facing, some things that have happened, and just talk about how it's going to impact us moving forward in what we call the new normal. I made a post on my Facebook yesterday that I lost a near and dear friend of mine with his battle with the coronavirus. Theo Welch was a friend of mine, a mentor of mine, and someone that, if any of you guys know that are following me, always had a smile, always lived with his heart, and would give you the shirt off his back. And I know we say that all the time, it's cliche, but anybody that knows him knows that guy did that. So I just wanted to kind of start my show by saying a thank you to him and paying tribute to him for any of the people that are watching, and because it meant something to me. But I know by this point, all of us have seen, heard a friend or family member or someone else's friend or family member that has been impacted by coronavirus. So this thing is real. It is 100% real. It is one of those things where we have to take it serious. We have to follow the guidelines, social distance. And I'm not by any means telling you to be a fear monger or anything like that, but I am telling you to take precautions and be careful because it is impacting people's lives. And that kind of leads me into the overall talk, right? Like, we've all had someone or know someone that has been impacted by corona from the just overall sickness, but the impact that this is having on not only the U.S. economy, the world economy as a whole has been ravaging, right? It's been impacting our communities left and right. I'll give you guys a nugget. If you go to tomhegna.com or search him on YouTube and look up his Economy Talk 2020. Tom Hegna is a mentor of mine, guru. Guy is off the wall smart. And I had a talk with him last week, and we were talking about some of these things, interest rates. And he really has said, man, since 2011 or 12, that interest rates aren't going up. They're going to go down because we were deleveraged. We had so much, money out there that we were borrowing and doing things like that. And not to, go over anyone's head or talk in the weeds, but his economy talk is very simple and practical. I would encourage you guys to go and listen to it. But some of the things that we're going to talk about today is the impact of the coronavirus on our banking system, interest rates, how to qualify for mortgages moving forward, and then creating your own bank. Let's start with talking about interest rates. Mortgages. Right now, moving forward, because all of this stimulus money is being put out there for small businesses, which is necessary to keep people working, to keep people, these small businesses that are the lifeblood of America alive, has been infused into our system. And the banks are responsible for delving out this information. Guess what? It's really put a halt on the financial industry. Right now, in order to qualify for a mortgage, you have to have a 700 credit score and 20% down. Pretty much no questions asked. It's one of those things where 700 credit score and 20% down is the standard. If you don't have that right now, you probably won't get a mortgage. So what that tells us is that we've got to do things a little bit differently. We can't wait for a 3.5% or 5%, down payment option to be able to get into a home. So we've got to take that savings for take it into our own hands, and we'll talk a little bit about that today and how we can do it, and some of the things that you can do as an individual to save some money and make things happen. Steve Pina, I appreciate you joining in. I've been watching your son Xavier at Petty. We used to play them when I was at Benedict's, but he's looking good, man. Congratulations on that. I think that's super, super dope. Rod Hughes, how you doing, brother? Rob Ball, thanks for joining in. My guy DTLR always looked out for me in the 757. Appreciate you, brother, for joining. But let's go back to the banking system, right? Like, let's talk about how banks use our money, right? If you think about it, you get your paycheck, it's direct deposited into the bank. Once that money goes into the bank, guess what? They give you an interest rate, which is point nothing, right? And then they take your money, whether it's $100, $500, $5,000, and then they loan it out with loans, car loans, credit cards, or mortgages, whatever they can do. And they're making 6%, 7% interest, or they're taking that money and investing it into the market, and they're making 12, 13, 14% return on your money that they're paying you back pennies. So one of the ways that we can talk is to how to create your own bank. And we'll get into that a little bit more. But I just want you guys to be cognizant about the interest rates that you receive and the APRs and APYs that you're paying out, right? Just gave you a bunch of analogies right there. So let's kind of talk through it real quick. Interest rate. What exactly is an interest rate? An interest rate on consumer loans are typically expressed or quoted in an APR, annual percentage rate. The rate is what you're paid. This is the rate of return that lenders demand the ability for the borrower to pay. I read that explanation right off of Google. You could too. Now let me break this down for you in layman's terms, okay? Because that's what we all live at. We live in a layman's term English environment. So an interest rate is basically a rate that a company has decided to give you. So let's say in your bank account, they're going to give you 0.5%. Well, that 0.5% is going to be calculated every month and annualized. You'll see annualized. Anytime you hear annualized, it's over a 12-month period. I know I'm not trying to say anybody's crazy for not knowing that, but for some, annualized kind of goes over your head. So annualized means over a 12-month period. If that interest rate is annualized over a 12-month period, that means it's paid monthly. As it's paid monthly, when you calculate all of it up at the end of that 12-month period, you'll get an annual percentage rate. That rate will be an illustration of those monthly interest rates paid to you over time. For example, if you have a savings account that's going to pay you an APY, annual percentage yield of 3%, the actual interest rate may be 2.9. And if you're being paid 2.9 monthly for 12 months, that'll end up at a yield of about 3%, roughly. Okay. Now, that's on the front side of it. We don't really pay attention to the front side of it, really. Most of us and most of the people that are following and watching usually pay attention more to the annual percentage rate, or your APR, because that's what eats up the bulk of our finances in most of our communities, right? Annual percentage rate is basically, let's look at it from this way. Your credit card charges you an APR, an annual percentage rate, annualized, right? Over a 12-month period. And most credit cards may have a 24% interest rate. So that means a 24% interest rate. That means I'm being charged 2% a month for 12 months. 24% APR, right? Annual percentage rate. So if I'm charged that 2% for 12 months, think about it this way. If we break that 2% down into a daily rate, it's like 0.065. I'm going to give you some math work. If you got a pen next to you, write it down. And my math may be a few pennies off, but I'm hopefully I'm close. So if you have a $5 card that's at a 24% annual percentage rate, which is 2% monthly or 0.065% daily, when you look at it, the $5,000 times 6.5 works out to be $3 in interest every day. If you take $3 in interest every day times 31 days in a month, you've now essentially paid $100 in interest that month on $5,000. So if you're only paying minimum payments of $100, you're only paying the interest. And guess what? If you keep that $5,000 balance for a whole 12 months, you've paid $1,200 in interest and paid $0 towards the principal. That in effect is not going to get you out of debt. It's not going to keep you moving forward. So what I would tell you is that these are the things that we should look at. The APR is the true cost of borrowing money. If you get a car for $20,000 and you get a 2% APR, you need to figure out what that number is going to be. It's probably going to say, if I get a car for $20,000 and the APR is 2%, I'm making up the numbers at this point because I don't have my calculator handy, but let's say 2% of that is going to be $3,500. Now your true cost, it's going to cost you $3,500 to borrow $20,000. So the better your credit score is, the lower the APRs that they're going to charge you. The lower your credit score is, the higher the APRs they're going to charge you. Banks, credit unions, so forth, etc. So I kind of want you guys to think through that. Make sure that you're paying attention to those things as you move forward through your credit journey, through all of the things that you do with money, right? If you see an interest rate, and speaking of interest rates, I wanted to share something with you guys. I always drop a nugget with you. If you go on greendot.com, Darvell, if you can put that up somewhere on the screen, greendot.com, and I want to make sure I have that. Greendot, GREENDOT.com. If you have any savings account that's not earning a lot of interest, guess what? Greendot.com is giving you 3% interest, 3% APY, which is annual percentage yield. And it's right here when you go to the homepage, 3% APY on any savings up to $10,000. So guess what? They're going to give you 3% on up to $10,000. I'll take that all day long for a year. Okay? You're not going to get it anywhere else in the banking system that way. So what I would tell you is to go to greendot.com. I have no affiliation with them. What I do is just search some of this information out and try and help my clients that we're budgeting with start their emergency savings in the Green Dot bank account. Ashley, now I know you're watching. You're going to say, why didn't I tell you that? Well, I just found this maybe a day and a half ago, because I know we talked about this maybe a week or so ago where you were putting some money into savings. So don't beat me up. But at the end of the day, I just found this Green Dot bank account, and I think it's awesome to be able to get 3% on your money. One of the other things that we'll talk about today, and I want to kind of go into, is if you think about banking, right? And yes, I'm a life insurance agent. I'm in the insurance business. There's a term out there called infinite banking. You can Google it. You can look it up. You can find out about it. But if you really want to know about infinite banking, I wouldn't tell you to Google it. I would tell you to go to Amazon and buy the book by Nelson Nash, and it's called Infinite Banking, Creating Your Own Bank, I believe is the term. And we'll talk about that strategy today. One of the things we want to do is have quick hits. Anytime you have a question, please ask it in the comments bar. We'll answer you as quickly as we possibly can. So Ashley asked the question, what are your thoughts on some of these car dealerships giving out 0% for 84 months? That's probably a catch, right? Yes, I would never, ever, 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 ever finance a car for 84 months. How long is 84 months? 84 months, so 72 is 6 years, 84 is 7 years. Most people don't stay in their cars for 7 years. I mean, think about all of you guys that are on this live chat right now. How many of you have stayed in your vehicles for 7 years? I mean, I still own the car that I got in college, right? It's beat down. I still own it. And then I drive an old 2015 car. So, I mean, I say old now. It's 5 years old. But we always have one old car in our house that we're going to keep forever. and we'll have a newer car that is a little bit bigger that drives our family around. But I would never, ever, ever finance a car for 84 months. 3 years is the best. 4 years is good. 5 years if you have to. But 3 years is the best option in order to finance a car. Because if you finance it any longer than that, then it technically probably means you don't have the money to afford it. And that's just being real. We don't like to hear that. And we just be like, oh, I'm only paying $500 a month. Let me say this to you. If you invested $500 a month into mutual funds with a 10 to 12% return from the age of 25 till you were 65, you'd have $7.5 million by the time you retire. Okay? So when we say we're only paying $500 a month, think about what else you could be doing with $500 a month. And along those lines, $100 a month from the age of 25 to 65 in a mutual fund that's getting 10 or 12% will get you $1.5 million by the time you retire. So when you think about this, none of us should retire with less than $1 million because we all can afford to put $100 a month away. That's the real reality, and that's speaking some straight facts to you. We waste money on a lot of different things. But if we get disciplined about putting $100 a month away, I know that it will return it over time. And by the time you're 65, you'll have a bunch of money saved up. So Ashley, I hope that answers your question around that. Any other questions, please type them into the chat feature here, and we'll answer them as quickly as we possibly can. The last thing I want to talk to you guys about is realistically, creating your own bank. The infinite banking process uses whole life insurance in order to create your own bank. What we would do is, I know we talked about the 3% savings. That's awesome. You can definitely do that. But one of the other things you can do is take your savings and put it into whole life insurance. Because guess what it'll do? You can use your savings while you're alive. It's still liquid. You still have access to that money within the first year. And then if something were to happen to you, your family's going to get, or your beneficiary will get a death benefit that's totally income tax free. Okay? But let's look at it this way. We talked about interest rates. We talked about how interest rates work and what they mean. If you put money into the infinite banking system, which is using whole life insurance, they're paying anywhere from 4% or a little bit more guaranteed. Okay? And when you look at that 4%, that's higher than the 3% that I just told you, right? And if you pass away, your family only gets that checking account. But if you have it in whole life insurance, guess what? Your family will get a death benefit that's greater than your savings account, totally income tax free. But let's look at the benefits of it, the living benefits of it. Remember we talked about that $5,000 that if you you left it on your credit card at 2% a month or 24% annual, that it's $100 a month or $1,200 a year. Well, let's just say you had $10,000 already in your cash value life insurance that you built up. You could borrow the money from your life insurance policy. The reason we say borrow is because when you borrow it, the life insurance policy still looks at it as though the $5,000 is in that account. So it's still going to pay you interest as if that money is still in that account. Okay? And when you borrow it, guess what you can do? Now you can pay off that credit card, and that $100 a month that you would be paying, your interest rate would now only be 5% simple interest, not compounded, simple interest. So if you look at 5% simple interest on a $5,000 account, you're only paying $250 a year in interest to the insurance company versus $1,200 in interest to the credit card company. So when we talk about the infinite banking structure and how you can create your own bank, you're basically setting up yourself up with savings, with deposits over time that you have access to, that you can use or borrow if you so need it, in order to manage daily funds, manage daily things that you may need, pay off debt, or heck, I've had some friends that had several $1,000. I'll give you one example. One of my good friends, one of my clients, when I was working at my other agency before we opened Granger Financial, was into real estate. And he had just bought a property, and he had two properties where all of his cash was tied up into these two properties. So he came to me, he was like, man, I really want to buy this, go to this auction. They have this one house I think I can get into, but I need 20 grand and I don't have access to it right now. I said, yeah, you do. You got $65,000 in cash value sitting in your life insurance. He's like, so what does that mean? Dude, we can get you a check by tomorrow for $20,000. You can go to auction, and if you buy the property, fine. If you flip it, fine. And then you can pay yourself back in your life insurance. You don't have to qualify for a loan at the bank. You don't have to have good credit to get it. It's your money that you're getting back. Long story short, he took the money out of the policy, went down to the auction. He didn't get the house, brought the money back, put it back into his life insurance policy. But the simple fact of it was the fact that he was able to do that. If you have more questions about the infinite banking, please go to our website, www.grangerfinancial.com. Well, Grant Cardone told me I don't need to say www anymore. So go to grangerfinancial.com. Again, it's grangerfinancial.com. If you want to email me, it's jeff@grangerfinancial.com. We would love to help you set up your infinite banking. We can talk to you about retirement strategies. And the last thing that I'm going to talk to you guys about is the unemployment numbers have gone up to 26 million people that are on unemployment. Okay? That means you no longer work at your job that you were working at. And you probably won't go back for some people. If you have a 401k, 403b, IRA, or any of those things that are at that old company, please go to our website, grangerfinancial.com, reach out to me. Let's sit down and talk rollover strategies to get that money away from the company that you no longer work for and into your control where you can manage these assets. Okay? That way we can get you to where you want to be financially. And now you're taking control of it and not leaving it to someone else. Because guess what? Out of sight, out of mind is no longer a strategy. It just isn't. Okay? At the end of the day, it's up to us to help each other become financially stable and get to our ultimate goal, which is living a retirement that is significant, happy, and doing what I want to do in retirement. And that's for all of us. I think we all can say that that's what we want to do. Okay? When we talk about that, we also want to talk about, hey, I am laid off. What do I do? Well, unemployment. If you're a business owner, reach out to us. Call us. Phone number to the office is 866-973-1128. One of the things we can do is we can try and help you save some money on your insurance premiums. The second thing we can do is I'll sit down and help you apply for your SBA loan. I have no problem doing that. That is no charge to you to help you apply for your SBA loan. Okay? Our motto right now is relationship over profit. We don't care about making a profit. It is about the relationship we create with our community and what we can do to assist in this time of need. So again, I'll leave you guys with this. This is one of the best speaks I think we've had. It was a conversation that was important. And I want to say this to you. My favorite quote is by Ray Lewis. It says, success is one thing, impact is another. We're all successful in our own right, but the impact we have in our community is the thing that we need to really, really go into and try and help others with. So I'll leave you with this today. I think we have a question out there. Let's see. What is the question, Ebony? I don't see it.
Would it be better to invest in the mutual funds and life insurance instead of 401k?
So I would not, depending upon whether the question was, would it be better to invest in mutual funds
And life insurance.
Instead of your 401k? I'm not going to say it's better because guess what? Mutual funds don't do that your 401k potentially does. Your company may match your 401k up to a certain percentage of your income. Okay? So I'm never going to tell you to give up free money. But when we sit down and you call us and we go through a plan, we may have a plan that consists of you investing into your 401k, you investing into life insurance, and having mutual funds. There's no reason that you can't have all of those things, because at that point, you would have a diversified portfolio. You would have some fixed income, which fixed income would mean life insurance. There's no ability for you to lose that money. You would have some speculative risk, which would be your mutual funds. Speculative means a little bit risky, but it would be diversified, meaning it's in several different companies or industries like consumer goods, financials, meaning banks, pharmaceuticals, or medical, meaning like Pfizer, Johnson & Johnson, things of that nature. So those are some of the things that we would do. So it would really just depend on your situation at the time and how we go through it. I'm not getting the questions up here. So is there any other question out there?
Whole life and term at the same time, a good idea?
Absolutely. Depending on your situation, I'll give you my situation right now. Whole life, you know, when I left my company and I was terminated, I had my own policy outside of work, and it was term, and then I had some that was whole life. Well, I had a lot of whole life when I was making a lot more money, right? So what I did was I lowered the amount that I was paying into my permanent policy, and then I increased my term. Right now, I bought a bigger term policy because I needed more insurance. I have a wife and 4 children, and each one of our children have whole life insurance. And then I have a small whole life on myself that I'll increase later as our business grows. So I do think whole life and term are good options depending on your situation. Absolutely, those are good options.
What is your suggestion investing in the stock market?
That's a loaded question, right? Like, what is my suggestion in investing in the stock market? I'll say that my suggestion and answer into investing in the stock market is philosophy. My philosophy is buy stocks that'll pay you a dividend, buy stocks that have been around for a long time, and buy stocks that are not risky, meaning they swing in price like this. You want consistency, like let's say we all buy this. Nike, that's a good stock. Amazon, Netflix, Zoom here lately, Delta Airlines, American, companies like that, I think are good options. Those aren't my stock picks that I'm giving you advice to buy, because I'm not giving you that advice. I just think those are good options once you do the research and you figure out if those companies meet your growth and long-term goals. What other questions do we have, Ebony? We got time for one more. None? Well, guys, again, thanks for joining our talk today. It was awesome to be able to get in front of you guys again. Remember, banking, create your own bank, start investing on your own for yourself. You have to pay yourself first. $100 a month over 30, 40 years at 10%, 12%. You'll have $1 million by the time you retire. You do the math. Find any calculator. If I'm wrong, email me and tell me I'm wrong. If you want more information about the infinite banking system, please reach out to us. GrangerFinancial.com is at the bottom of the screen. GRANGER financial.com. Email me, Jeff@GrangerFinancial.com, or give our office a call, 866-973-1128. I look forward to hearing from you all. Thank you so much. Have a great day.
Drug addicts.